Welcome to Passive Pockets, the passive real estate investing show. I'm your host, Chris Lopez, and today I'm joined by Matt Sinclair, the founder and CEO of MIP Capital Partners. So we're going to cover the market from the lens of an operator who's focused on the build to rent or BTR asset class. So we'll talk about the long-term trends on there, the markets he's selecting, how he's underwriting risk. Plus, we'll talk about the 21st Century Road to Housing Act that got passed July 1st. Which is going to have an impact on BTR and real estate investors in whole. So it's a great conversation. Let's jump into it. Matt, I'm glad to have you back on the show, as I always enjoy our chats about the market. Before we jump into details, welcome back and remind everyone about your background, please.
Well, thanks, Chris. So I spent the majority of my career in investment banking in New York City, primarily with JP Morgan and their real estate investment banking team. So worked across a variety of real estate subsectors, including multifamily and single family. Also worked at a $4 billion multifamily focused Sunbelt fund. Sort of learned a lot about private equity from that perspective and ultimately launched this business, MIP Capital Partners, to capitalize what I think is a real long-term secular trend around build to rent. So I'm grateful for the opportunity.
Yeah, so let's talk of that because, you and I connected 6-7 years ago, and you dig into the numbers, you dig into the trends. So kind of give us the 10-20-year view on the economy, the trends, and why you like BTR so much.
I think I'll start with the BTR question. I think home affordability, that's a major issue in the developed world generally and specifically in the United States. And there's many factors contributing to that, not just elevated interest rates. And so the period of time that people spend as renters before those individuals are able to purchase homes has been elongated. And a lot of people want to transition out of apartment buildings, multifamily, and build to rent kind of fills that gap. There's also just some demographic changes. A lot of folks aren't necessarily looking to be homeowners anymore. They prefer renting, and there's a lot of flexibility with that, and that can be quite favorable. And then the other cohort of people that really enjoy the opportunity to rent are empty nesters. And so that's frankly a lot of our tenants and fantastic tenants. So a lot of long-term secular trends driving real demand for the build to rent product. And it's a relatively small part of the real estate market. And in many ways, it's 20 to 30 years behind where multifamily is now, which is a heavy institutionalized asset class. And so I think there's a real opportunity in build to rent, and it's obviously gaining momentum, and over the years is going to, I think, become a larger real estate allocation for pension funds and other institutions.
So when you say it's 20 or 30 years behind, traditional vertical multifamily, what do you exactly mean by that?
So, it's interesting if you look at where, Blackstone, I did fortunate enough to work a lot with those guys, excellent firm. They were a real pioneer in this. And if you look at where multifamily was in the mid to early 90s, it was sort of just as, computers and technology and spreadsheets had really changed people's ability to analyze deals quickly. And so by early 90s, there had been a wave of institutionalization in what had been a very local, family-oriented business. And so it became an institutional asset class. And again, then once it gained momentum and became efficient and there were data sources available, it was something that institutions became very comfortable with, to the point now where large multifamily characterizes 250 units and greater has obviously largely institutional holders. And again, another reason there is obviously just the price point. It's to the point now where at the larger end of multifamily, it's a pretty efficient market, not to the extent that a stock market is, of course, because of information asymmetries, but everyone's using more or less the same assumptions. They're doing the same value add plans and so on. And there's still differentiation by the real great operators, but it's a pretty efficient market. And there's some just real great landlords out there in the apartment space. You can see the similar trends beginning to occur, but it just took much longer with single family. It's really in the wake of the financial crisis that some innovators, including Blackstone, built out a platform that ultimately IPO'd as Invitation Homes. I had the pleasure of working with those guys over the years. They're fantastic operators. Same with American Homes for Rent. Really, truly great world-class organizations who were at the forefront of institutionalizing this asset class. But that really didn't begin until 2011 to 2014. And so that's much later in the game. And if you think about why, a lot of that, I think, just from my own experience, is the technology penetration in the sector. It was before you had the ability to have like online property management software and so on. It'd be very, very labor intensive to manage 300 single family homes, whereas one apartment building with 300 units would be substantially more efficient. So for the longest time, people thought it might not be feasible to institutionalize single family. But with technology, that has definitely been the case, at least increasingly over time, to the extent now where I think the next vector of growth in single family is really contiguous build to rent developments. And I think the legislation that's passed is really going to exacerbate that trend and continue the trend towards the institutionalization of single family to the extent where in 20 years, it'll probably be just some different version of where multifamily already is. Large, well-capitalized institutions trading among each other. And so I think that presents an incredible opportunity for up-and-coming firms like MIP Capital Partners to be an early entrant. And it's still early days in the consolidation of that industry. And I think it's a good opportunity.
We scheduled this podcast 2 weeks ago. Between the time we scheduled and recorded it, we are recording at the 21st Century Road to Housing Act. It became into law, mid-July here time frame. And obviously, there were some BTR aspects in there. There were some landlord aspects in there. Can you give us a breakdown of that bill and how that might be impacting your business or how you think it might impact the BTR industry? Because I know from a high level, but you're probably eating and breathing the stuff the last year as it's been in the works.
Yeah, I know. And it's something I've been communicating a lot with our investors individually. People were quite concerned because it was, announced in January. It was somewhat uncertain. Then in March, some fairly draconian measures were proposed. The 50,000 foot takeaway of what actually has passed is it's far less draconian than what people feared, to the extent where for a lot of us, it's going to be pretty much business as usual with potentially some additional compliance. So build to rent critically is exempted from the 350 house limit. So they call them large institutional investors, defined as 350 houses or more. Contiguous build to rent is actually exempted from that. And there are some specifics. That's a big deal. And so firms are going to continue to be able to grow as long as the houses classify as contiguous build to rent. And I think just for the listenership, that's a very important distinction between scatter site single family homes and contiguous build to rent. Scatter site single-family homes are just like regular homes in a neighborhood zoned individually and financed individually. Contiguous build-to-rent communities in many ways are more similar to multifamily than they are to scatter site, just insofar as the zoning and also just the way they're financed. You can use agency financing, for example, for contiguous scatter site communities, and they often have common amenities and so forth. So the pathway to growth for the big players is going to be those contiguous communities. I think there's less PR risk.
So I've talked to a couple, local real estate brokers here in the Denver metro area, and some have worked with, various hedge funds and iBuyers over the years. And they've said, last couple of years, at least out here, it's just been, they are disposing of the properties. They're not buying, they're all disposing. And you have your foot in the institutional world. Is that a trend you've seen institutions do for a while nationwide? Is that Colorado specific? And then is the Housing Act going to, force more of these bigger firms to start selling their, individual holdings?
It's really a cost of capital situation. I think it's where interest rates are relative to cap rates. If you look at what occurred with the pandemic housing boom, it caused a pull forward of demand, essentially. And we are experiencing a cyclical readjustment from that. So that was a period of time, the pandemic-related housing boom, where price appreciation and rent growth vastly exceeded wage growth. And so if you think about it, ultimately real estate, like residential real estate, multifamily, is going to be governed by people's ability to pay rents. They can't afford rent increases forever, and people's ability to pay rents is a function of corporate earnings and so forth, which is itself levered to overall GDP growth. And so there's constraints, and as something booms, it tends to have a readjustment period, and we are experiencing that right now. And so a lot of very large institutions have been net sellers. If you look at the data, a lot of institutions have been selling out of specifically older homes. So the run-up in inflation that we experienced from the pandemic, it's decelerated, and the latest data suggests it's decelerated quite a bit, but it's still off at a heavily elevated base. So the cost to repair homes has gone up enormously. And so a lot of the dispositions are focused on the lower end of housing. So C grade and even B grade houses, the big institutions are basically disposing of those houses and looking to go newer. So a lot of the new growth has been in build to rent because it's just a lot more efficient to operate new construction houses. And a lot of the big institutions have been divesting out of their older holdings just because there's NOI margin erosion over time as houses become older, things become obsolescent, start to break, and so on. CapEx burdens go up. And so really that's what it is. They're looking for recycling of capital out of older houses and into new ones.
How much of it is also just like cost of capital, right? Because they were buying, single families at a low 4 cap rate, but they were borrowing, I'm assuming, in the 3s or something. How much is cost of capital impacting that?
Enormously. I mean, that's probably the single biggest point. And I think the big thing is where interest rates are relative to what the expectations of where interest rates would be. So if you look 2 years ago, and I was just looking at benchmarking that I did of Wall Street consensus estimates exactly 24 months ago of where the 10-year treasury would be now versus where it is about a percent difference. I mean, 10-year treasury is about 4.5% right now. Wall Street consensus estimates 24 months ago of where that number would be now is about a full percentage lower.
So you're saying you went back and looked at, so the forecast from 2 years ago, we're saying, hey, in 2026, the 10-year will be about 3.5, and now it's around 4.5.
Yeah.
But we're a solid point off. Okay.
Big, right? There's an incredible difference, and there's a lot of inflationary pressures now embedded within our system. Some of them will abate. But if you look at, like, Goldman Sachs just recently published at the end of June, their 2035 forecast for the 10-year treasury, and it's at 4.5. It's basically unchanged for where it is. So it's difficult to forecast interest rates, but the point is the market's becoming a little bit more appreciative of the fact that rates at the longer end of the curve are likely to remain elevated. And so that, like to your point, the cost of capital situation, if cap rates nationally are, in the 4s, and the 10-year treasury is 4.5, you're going to have the spread on the 10-year. That math doesn't pencil particularly well if rent growth is quite low, which it's been. That's the calculation. And so, like I said, there has been net purchases in build to rent, like new contiguous development specifically, but overall, there are net sellers and exiting largely older assets. But really, yeah, it's an interest rate situation. But that also presents certain opportunities as a buyer. So a lot of high quality builders will sell really great homes at pretty sizable discounts right now. And that's really the basis of our business plan. We were of the view that rates were going to be higher than people thought. Now, I didn't think they would be as high as they are, but our forecasts were that they were certainly going to be a lot higher than consensus had them. And so our whole business plan's been basis investing, just based upon getting into assets at really favorable terms, not needing elevated appreciation, and just kind of grinding out strong distributions to investors that way. And that's I think the only way to play build to rent and residential and multifamily right now, generally speaking. I think the era of the elevated appreciation, that's last cycle. And I think this cycle is more about operating prowess.
I would agree with you there. So I want to talk about your thesis and your fund. And so I'm sure some of our PassivePockets listeners remember, I think it was last year, we came on and, you present your fund, you talked about it. And if I recall correctly, you're doing it, just buying the, new single family homes from builders at a discount, good locations, good school districts. You're in the Tennessee market, right?
That's right. Yeah. Our first market, and we're very specific about the market. We're in suburban markets of Memphis, Tennessee. And so for the first market we were in, given the state of interest rates and housing generally, we chose a market where cap rates are high enough to facilitate cash flow. Longer term, there will be a time when it makes sense for us to enter other potentially higher growth markets. But my thinking, a couple of years ago was if you enter a lower cap rate market, you're paying forward for future growth that might not materialize. And we don't want to be taking that risk while we're a smaller fund and we don't have the cost of capital of an American Homes for Rent. So you want to be defensive. And I think the value proposition in the Memphis suburbs is really interesting because it's such a dichotomous market in Memphis. You have the urban core, which frankly, the population is declining, but people are moving en masse to the suburbs. You have areas of elevated population growth, strong schools. They're quite safe, actually safer submarkets than national averages and so on. And so it's sort of an area where we really know very, very well, sort of market to market. And it's really, frankly, working better than expectations. So I'm quite proud of that. We launched Fund 3 in the fall of last year, and that's going really well. Our investors are very happy. Fund 2, we launched that in the spring of 2025. And so it's been able to show investors over a full year of performance now post stabilization from that. I mean, I think that's really good.
Is the Fund 2 investment strategy similar to Fund 3, scattered site, Memphis suburbs?
Yes, that's right. It's exactly the same. So they're quite comparable. And so I bring it up because, there's a full more year of performance. So it's quite indicative, I think, of what we'll hopefully be achieving with Fund 3, at least so far on a preliminary basis we have. Another key thing about markets, they're so idiosyncratic qualitatively, but also quantitatively. The margin profile is extremely different depending upon different areas within the United States. And obviously that varies for a variety of reasons, but two of the main factors are just insurance costs and property taxes. So in the Memphis market, we're luckily shielded from a lot of the issues and challenges that have driven up insurance rates. So our insurance costs for new construction housing is really favorable. And the property taxes are also relatively low. So our margin profile is really quite favorable. And so if I can give an example, we underwrite to about a 70% NOI margin, which that's high. But if you look at, American Homes for Rent or Imitation Homes, some jurisdictions, they do quite a bit better than that. Our T12 actual as of March 31 was 79%. So we did much better than expectations. And on a CapEx basis, which I think to your listenership, very, very important, often NOI margins in a capital intensive sector like real estate can look quite good, but the NOI doesn't tell you anything about what capital it took to get to that. And so looking at things on a CapEx adjusted basis, I think is really important. So in our financial reports, I break this down. So our NOI less CapEx as a percentage of revenue, we were modeling about 68%. We achieved 77. That's really important. And that shows that we're generating a lot of cash flow. So at the end of the day, from the rents that we bring in, we're converting a lot of that into cash for the benefit of investors. And I think that speaks to, the team that we've assembled here. We have an excellent property manager who knows the area really well. We know exactly what tenants want. And in this cycle, I think grinding out in a month-to-month performance from a financial perspective is really going to be key. I think, like I said, it's going to be a story about the best operators, not necessarily, who is the most aggressive and then got lucky on appreciation. I don't think we can count on that in this cycle.
One other thing before we move on, I want to talk about the NOI margin there. So you were forecasted 70, you're at 79. Where did that come from? Higher rents, less expenses? Like, where did that margin increase come from?
Interestingly, it actually wasn't from high rents. I think there's a misconception sometimes in the business. People put too much emphasis on rent growth. So we want to be in markets where you could mark to market if a tenant moves out and get higher rents, of course. But much more important, I think, is keeping good tenants in place. The things that really cost you cash are vacancy and turnover. The cost to turn a house is up astronomically over the past 5 years or so, 5 to 6 years. I mean, it really is a difference of kind versus degree, to the extent that if you look at the publicly traded home builders, there's one in particular who's run into real financial trouble. And the main reason is because they're down market. And so it's costing so much to turn properties. The CapEx burden is so high, they're no longer able to service their debts. Whereas the guys who are a little bit higher grade, who have a newer grade of housing, it's just much more efficient, and their cash burn per house per year, like the cost to maintain, is much, much better. And so it's having studied that created the foundation to launch the business and focus specifically on suburban markets and new construction. And it's just much more efficient to do that. Your question was like, where was the beat? It really was just maintenance and repairs. And then, property taxes came in a little bit lower on that. That's not something that we would bet will continue because there's some certain degree of arbitrary assessments there. I think it's probably because we've been somewhat conservative in the way that we underwrite things generally, but really it comes down to just far less maintenance and turn expenses. And then again, the cost. I don't underwrite things assuming the benefits of new construction. I basically assume that every new construction house eventually won't be So I'm assuming, more Class A single family. So there's a degree of buffer built in here. I'd always rather err on the side of caution just because you never know, like there could be a storm or you need a roof repair or there's something like that. I'd rather always side on the point of caution.
We all know the wind boogeyman of real estate, right?
Exactly. So, but I'm happy to report that, it's well over a year in with Fund 2 and the financial performance has been quite good to the extent that our EBITDA at the fund level for Fund 2 is 49% above forecast. So quite happy with that.
So what's that translate into? Like, what was your forecasted, cash on cash distributions and what's been the actual, if you can share that?
With Fund 3, for example, we have an 8% yield on Class C and a 7% on Class B. And so those are the two most common. We also have a Class A, which has a 9%. That one doesn't have upside. So again, it's about in Fund 3, 7% yield paid monthly, and then Class C, which is a little bit of a higher price point, that's 8%. And so we've actually, with Fund 3, we stabilized that earlier this year. We've paid 5% more in distributions overall than we forecasted, just because we've been beating the forecast on several areas, but one of which was the lease up. On Fund 2 overall, which we have a bit more performance track record, just been around longer, we've paid exactly 10% more in distributions than we had forecasted. And really, that's just because our cash position has been better. Main reason there was, again, a favorable lease up, and then our margin profile has been better. So overall, cash, we don't do a refi, so it's your cash on cash return. It's not a metric we use, but we do use like a yield metric. So we've been quite good on that. I think the other key point is it's tax efficient.
How is it tax efficient? Why isn't it just ordinary income?
Because this is a real estate investment and the LPs are owners, they do get the benefits of tax depreciation. At least to a lot of our investors, that's pretty significant. So when I present the information to the investors, I show it on a unadjusted and then a tax adjusted basis, and it's quite significant. I would never do an investment just because of the tax benefits, but I will say the tax benefits are pretty remarkable, especially since in July of 2025, the bonus depreciation rules were augmented such that there's non-expiring 100% bonus depreciation for the year in which assets are placed in service. So it's quite significant. Everyone should consult his or her own tax advisor, but it's been an incredible additional benefit to our investors in both Funds 2 and 3. Big difference between Fund 2 and 3 is that with Fund 3, we added a degree of direct lending. And so, if I think about the environment we're in, if interest rates are significantly higher than what was forecasted and a lot of business plans were based on the idea that rates would be lower, it stands to reason that being a lender is a good business to be in. And I would make the case that equity is at least fairly priced right now. If, like I said, if rates are higher than expectations, there's a good chance that in inflation-adjusted terms, real estate pricing could be sideways for a few years. That's why our business plan is not necessitating elevated appreciation. I think it follows as well that being a lender makes a ton of sense. And the key there is just making sure you don't dilute credit quality to try to scale. With our Fund 3 right now, just the appraised value of the portfolio is about $18 million. We have financing on that such that the equity value is about $5.8 million just by the numbers. And we have about $1 million of a loan book as well. So $1 million of loan book relative to $5.8 million of state equity. So that's just a comparison. We're relatively small, but we're, looking to grow over time. And then we have a fairly sizable cash balance. This matters because in sum, as of about May, when I presented this to investors, there's approximately 17% equity value creation to investors, just on paper, if you take appraised values by the third-party objective appraisers. That's really the essence of our business. It was, what's the best play in real estate right now? Well, it's getting great value from high-quality home builders because they're holding these houses on their books and paying incredibly high rates of interest. They'll give us really favorable pricing if they know we're a reliable purchaser. So all in, we raised $6.4 million of equity from our investors, and we're very fortunate to be able to do that. As of May, the implied total equity value to LPs was about $7.5 million based on the appraised values of the houses and then loan book and cash balance and so on. That's about a 17% increase in the basis. And so again, that's really the essence of our whole business model, what we're doing right now. And from that point on, we don't necessitate a high rate of appreciation. We just want to make sure that we operate really well and can pay people the distributions. I think the distributions are a main reason why people invest with us, and sort of our focus on risk management and the stability. It seems to me, having talked to our investors, day in, day out, that's something that people really value.
Give me cash and don't lose my money, right?
Yeah, no, absolutely.
You're talking about like BTR, we're still, very early in the marathon. And I'm curious, you're talking about, scaling MIP capital. How does the 350 home, I guess per investor, per large institution, whatever way it's categorized in the new law, I imagine you'll hit that ceiling one day, right? You're buying scattered site, single family homes. Does that impact your current funds or your medium to long-term business plan?
There's certain elements of the legislation that the Treasury is still working on. So there's certain edge cases where they're deciding. As it stands, like a literal interpretation of the language in that the Housing Act, starting in 180 days from the day that it became law, so that basically what would end up being January of 2027, that's 180 days, there's a 2-year window of time where large institutions can buy from sub-institutions. So during that time period, we would be able to sell directly to those large institutions. As it currently stands, after that window of time, it's not clear that we would be able to. And so that creates an odd situation. And that's, like I said, the Treasury is currently looking into this. However, contiguous build to rent is exempted. So I think the vector for growth in the industry generally is likely to be contiguous build-to-rent developments, just because there's a lot more clarity around this. And, regulatory creep is real, and there's many, many variations potentially at the state level. And so I would say, scatter site single family still is definitely going to have a place, and there's certain exemptions. Like, so for example, if you were to buy a scatter site home that requires like 15% more of its purchase price in the form of renovations, then that qualifies. And if you were to buy a new construction home from a builder, you're allowed to do that. But the question then would be, how do you sell it and who do you sell it to? So it really depends. And there's a lot of things they're still working out.
So there's a lot of nuances still left to figure out.
There are, and it's really not clear yet, and the language in the act is somewhat vague. And so, like I said, the Treasury is working through these things. So we're making sure that we're armed with a plan regardless of market conditions. And I've told our investors, it's our job to do well regardless of market conditions or the regulatory environment. Our job's to figure out the best way to deliver, and that's what we're going to do. So we have a path to grow through future acquisitions of scatter site homes. We also have a path to grow through contiguous acquisitions of built-to-rent communities.
We got a few minutes left on here, man. I want to spend the last few minutes talking about interest rates, right? We were talking about this briefly before the podcast got started. You already talked about, hey, we're about a point higher than where Wall Street forecasted a year ago. And, a lot of investors, including myself, I've had this conversation, 12 times the last 12 days, it seems. The market we've had signs of optimism, right? We had that, then, the Strait of Hormuz stuff, I think, quashed out of the market in February. And I think, and it's like, well, hey, we've already had a correction. We still have those inflationary pressures. The 10 years higher than expected. We still have this wall of maturities. The main is not crested yet, hitting the market, for multifamily and commercial in general. Extend and pretend is still extending and pretending. Part of me says, hey, there's a lot of pressures building up to where I could see, hey, in 3, 4, 5 years, rates are higher and prices are lower. We might go through that cycle, right? So I might kind of like half negative, half positive. How are you viewing that? Like, how are you interpreting those tea leaves? And also, how do you mitigate that risk, right? Because you don't want to sit on the sidelines forever.
Absolutely. Be incredibly careful what you buy. And you got to make your money at the buy. So environment of elevated interest rates, there's another side to that, which means builders need to build because they've got overhead. They need to keep their people busy. They don't want to lose quality people. It was so difficult to get high quality construction tradespeople during the pandemic. People learned the lesson. They don't want to lose those people, but they need to keep building. If you're a reliable buyer, and you have a good relationship with the builders, they'll give you very favorable discounts on great houses because there's certainty of closing. So the margin that a builder will need from a high quality buyer is less because of more certainty. When a buyer sells to primary homeowners, it's something like 10 to 15% of all primary homeowners who are under contract to buy a home from a home builder, they withdraw. A lot of it's can be difficult to qualify a mortgage and so on.
What was the percent? So this is for owner occupant under contract for new builds.
Yeah, it can be 10 to 15%. That doesn't sound necessarily that high, but from the perspective of a builder, that's a lot of risk because a lot of those homes, there was customization involved. It's a lot of time that they put in with those clients. If we come in and we buy at once from a builder and we know them, that we've been in business a while together, they trust us, we can get high quality homes at really great prices. And to some extent, that elevated interest rate environment helps us just because it's economic for the builder to sell and get it off their books, because imagine carrying a lot of homes on your books and eating interest expense month to month and not knowing when you'll be able to sell them. So that's the benefit. But I would say to investors, be really careful and don't jump into anything. I think it's better to not make an investment than to risk making a bad one. And I would also say, to our discussion earlier about lending, I think the current environment, equity investments, I would say appreciation in the real estate market, at least nationally, is probably going to be, again, still limited for a period of time. It might track inflation at best, but potentially not. I think if there's a way to be on the lending side or invest alongside someone who is, I think that's probably the best play in this cycle.
All right, Matt, this was great chatting with you. Like I said, I always enjoy it because you are so thorough, your analysis, and you come so prepared and articulate. We'll have to maybe bring you back on in January and February, and hopefully there's some more clarity on the housing clack. But thank you so much. And where can people learn more about you and MIP Capital?
MIPcapitalpartners.com. Something I think we take a lot of pride in our financial reporting. If anyone would like an example report, I'm happy to send that to anyone and hop on the phone and kind of walk through it. I really love doing it. And I think it really tells a story about what we're doing, but also I think just generally with single family, it dispels a lot of the misconceptions that exist in the industry. I think we can work through those with the numbers.
Matt, this has been great. I would encourage anyone out there, if you are interested, Matt does very detailed reporting. It's a great read if you enjoy that. So I highly recommend it. I've also known Matt for a number of years. So we have some fun conversations. We trade deals back and forth. It's just an overall, a really good guy to network with. Matt, thank you so much. We appreciate your time.
Thanks, Chris.
So a big thank you to Matt for joining us today and sharing how he's viewing BTR over the next 5, 10, 20 years in the market cycle. So if this episode helped you sharpen your investment process, please follow the show, give us a like, and then make sure you go to PassivePockets.com to get more information on how to become a better passive investor. As always, thanks for listening and happy investing.